we have a couple of questions. So somebody asked, how big of a stop do you usually use in the crude ES and GC for day trading? So I don't really trade gold. It's a little too volatile for me, but people do like it, and so I watch it once in a while. I have traded it in the past, but I trade crude and S&Ps. So I'm a big believer in keeping your stops very small. Like 2% of your account is 2 to 2.5% is about the maximum I would ever go. And if I can get a stop in that's less than that, I will. So you can kind of figure it from there. So if you've got a $10,000 account in the S&Ps, you want to keep your stop around 150 to 250 max, right? So that's 3 to 5 points max. Same thing with crude oil, no real difference. Sometimes volatility expands and the stops need to be a little bit wider, but you can set wider stops for like an emergency, and then you watch the market really carefully, which is generally what I do. And if the market starts to, there's no sense in standing in line for the guillotine. If the market's coming at your stop, you can get out earlier. So that's my, but between 1.5% and 2.5% is risk against your account is a good, and you don't have to go all the way up to that. I mean, if you've got a very large account, you don't have to go the full 2.5%. Just don't trade as big. Can you tell us why you prefer a time-based chart, 5 minutes for CL over a tick chart? Yeah, generally because, James, the activity is less. We've got a lot of activity on the S&Ps, and so it's very conducive to a tick chart. Less volume or activity on the crude oil, so you'll see tick charts work, but I just like the 5-minute chart a little bit better. How do we interpret a big up move in price that has very little volume on the Weiss wave and vice versa? It's suspect. You would not to say that if you get a big up move and the volume is low, that you just stand in front of the train and try to short it. I wouldn't suggest that, but just be suspicious of it. And vice versa, choppy short up move with very high volume on the Weiss wave. Well, a choppy short move, up move with very high volume would be what we call a lot of effort to go up, but not a lot of result. So we call that effort versus result. Effort versus result or reward. So if you have a lot of volume and the market doesn't move that much, either up or down, then it suggests that the opposite is actually happening. So if we're going up and suddenly we don't make much movement up, and yet we have a lot of volume in there. So what does that mean? It means that somebody's stepping on the market. Yeah, there's a lot of buying going on because the volume is high, but because the price isn't able to move higher, it suggests that somebody's in there capping the market, somebody being stronger players with a lot of money in there selling into the buying. 9 times out of 10, the next thing you're going to see is the market move down in a bigger wave down with good volume, and then you look for the weak. That's your first lower low trade. You look for a weak pullback, and there's your short opportunity. And the same thing happens in reverse. If we're coming down and then there's a lot of volume and we're not making any progress down, it's effort to go down, but no result. And so we're going to look for that first higher high trade in there. Good question. We talked about the clock being cool, and we're all set here, right? Okay, craveworldclock.com. Yep, that's it. Funny thing. Okay, let's get to Tuesday's trading in the S&Ps. Look at that. There's nothing going on there. There's no trade setups, so we don't trade it. If we look, we can see that Tuesday was, here's a daily chart I put up against this, And it's an inside day. It's inside the range of the prior day. Here's the range of the prior day. Sometimes it's called spread, but it's basically the difference between the high and the low, the area between the high and the low. And you can see that this day traded completely inside that day. That day, you know, we saw a couple of nice trades in there and a lot more range, a lot more movement. This day had very little. So, you know, how do you trade this? I don't know. There's no good way to trade this. I wouldn't try to trade it. So we just sit on our hands and not do that. Go to a different market, okay? Now, it's an inside day, but don't despair that there's been no trading, because it means that the next day or two, you're going to see more volatility and more movement in the market. So get excited when you see an inside day, because it means that the next day or two is going to be a good day of trading. And either shift to a different market or take a break. Go play some golf or something. So let's take a look at gold on Tuesday. Wow, look at that, huh? Lovely up thrust. We have the move up to A. We'll talk, I think, let me see if we're going to talk about the volume on that. Yep, at some point we do. So we get the move up, the classic up thrust, a move up to A. You can see that if we, you can see all kinds of stuff. If you start looking here, it gets overbought up in here, right? In that trend channel. If we put one on, then we have a reaction down to B, and then we rally up to C, and we close. We see a couple of bars try to get up. I mean, this is like a heads up right in here. These couple of bars are like telling you this has got problems, because if we're pushing up and we're going to break through, then we ought to really pop, you know, push and pop right away. But it's not happening here. It eventually on this bar finally gets up and over the top, and then we see the next couple of bars closing poor with those top tails very weak and shortable right here on this bar. Alternatively, you can short the test. Now, tests don't always occur. Here it does. So you can either add to your position as this is starting to go down, right? You pyramid down in here. Or if you didn't take the short here, you certainly would recognize this as a great opportunity to short the test of the up thrust here. Just a quick comment. Notice that, just to give you a little more sense about shortening of the thrust on this. So here's the high of this bar. The next bar going up, we travel that amount of distance. The next bar going up, just looking at the high, I know it closes on the low, but just looking at the high, it travels that amount of distance. And the next bar up travels that amount of distance. So each thrust up in price action, in other words, each run up, we go from long to shorter to short. And that's shortening of the thrust in the price bars. Shortening of the thrust in the price bars. And then the next bar closes down and underneath the other two, and there's your key trigger. You knowing that there's shortening of the thrust, if you're skilled at this and see this occurring in here, and you see the market starting to fall down, then you can short it a little more aggressively if you want to. How do you define a test? Well, let's talk about that. Let's go through all of this, though, before we get to that question. We see high volume here. We want to look at the background of this a little bit. We see very high volume at A. We don't see any of that volume all the way back. Now, obviously, this is the overnight market, but this is also in the early European session. This is before the American session starts. So that's very high volume for that, for a 5-minute bar on that time period. And also, look, it goes straight up and it closes in the middle. And then we start to come down. That's climactic action right there. This is a buying climax. High volume, straight up, sudden increase in volume, poor close, and then a reaction off of that. And then we try to rally up and look at the choppy rally. Not much volume on that rally. Then we come down and we have high volume on the way down. Now notice, this is a spring. This is technically a spring, but not one that I would be interested in. Why? Because the climactic action and the weak rally and the high volume coming down. Now this does work out, and it does work out nicely. And sometimes that happens. We will look at a trade setup. We know technically it's a spring, but it's not one that we're interested in because of the characteristics that I just described. And so we don't take it, and it works out. Well, that's life. You know, that happens. So we miss the trade, and it's not included in the trades that I've talked about. And if you think about it, you know, if you've got a trend line coming up, the line's also broken. You have all these indications of weakness: overbought, buying climax, weak rally off of the support. We go under the support on high volume, so supply over demand. Now, sometimes, you know, the market does what it wants and it does continue to go up. It's still fairly strong here, but it would not be, though, for all those reasons, I would not qualify that as a choice spring, even though it does work. So now we rally up and we come up. We don't have a lot of volume coming in. We have some good volume. We have some volume coming in. Price action's pretty good coming up. And then look at what happens at bar 3. We get that sudden increase in volume and a poor close. Stopping volume in here, or climactic action. Honestly, it doesn't matter what you call these things. The point is you recognize this is demand trying to drive up and supply stepping all over it. And we know that because it's unable, if this was all demand on that kind of volume, we should be shooting up and closing up in here. Okay, but it doesn't happen. We see the market closing underneath this level. Then it rallies up on 4. Again, we get high volume and it closes poorly. Okay, we might have actually shorted on 3. Okay, we might have shorted that on 3. And we might have gotten stopped out. But by the time you come back here to, and you might have been, psychologically, you might have been a little bit of shell-shocked, and you just took a stop out, and it might have been hard to get back in here. But then look at what happens. Look at the move down to 5. Good solid flow to the downside. Volume expands to the downside. It increases to the downside. Then we come up here, and this is this market is more volatile than the others. We don't have this is pretty good flow for the first couple of bars here, pretty good movement up. But look at what happens when we get up in here. We get the shortening of the thrust, and the volume is low. It's this volume in here, right at the top. So that's the definition of a test. Is that when we come back up into the area and the volume is small and the price action dies out on us. And volume expands again to the downside. We get a little climactic down here. We rally up, no volume coming into the upside, and we get another spring. We get another up thrust in here that we can take. Remember, the targets of the up thrust are to take out the swing low, and it does here. So, and we would be probably out of this. I'm making too much look like a kid here. So our swing low, we'd probably be out on this bar or close to that bar. And then on this up thrust, we would enter in here, and we want to take out this swing low, and we do, and we'd be out somewhere in here. So we have 2 up thrusts in a row. Oh, what's the name of it? Yes, Weiss wave. It's the Weiss wave. This is standard volume. The blue and the red. Weisswave. Weiss wave. You can find it on my site. You can see it there. So a test occurs on low volume. Yes, it occurs on low volume. That's right. That's exactly right. It has to have low volume. Now notice also, this upthrust occurs in prior support here at 2 and at 5, and it's now become resistance over here. This is an upthrust I love. This is the kind of upthrust I love. When I have failure to follow through to the upside against significant resistance. Okay. I love this look, and this is a no-brainer to take. It's too bad this was kind of late in the day for gold, because it's a solid trade setup. Let me see if I've got other things here. So we talked about climactic action. We talked about increased volume to the downside on the reaction. This is supply coming in. We talked about the high volume port close for the selling up around 3 and 4. And then the heavy downside volume on 5. And the targets. I think I covered it all. Yeah. Okay, good. Old support. So old support in here, now resistance. We talked, I think, about this with springs, or maybe we didn't yet, but we're gonna. Yeah, it's kind of too bad. I thought it would, reach the low of the day, but it didn't quite do it on this. And sometimes that happens. You've got to, this is, compare this move down with this move down. Right? This is really strong coming down, and this is fairly choppy coming down. You've got price bar overlap coming down. So when this happens, you've got to be pretty aware of the market turning back up at some point. And, right here is the bar that tells you the market's turned back up. D is an upthrust that sets up the first lower high after the major upthrust. Yes, that's right. Well, yeah, that's right. That's right. It does. And it breaks through the congestion there too. So, but this occurs in an upthrust format. So the this is more salient than the first, because this could be the first lower high here. And so let's just go through that a second to be clear. Let's assume that you thought that this was the first lower high and you got short on this bar. So now your job isn't just to identify trades, it's to really to manage them. All right. So we come down, the next bar is good. It closes on the lows. Then we get a bar that comes up and you say, okay, well, we'll give it a bar. And then the next bar holds, but it's level to that bar. And then the next bar comes down, but we don't make a new low. And then the next bar comes underneath all of that and kind of gives you a little mini spring. This is a tiny little spring, not something to trade, just something to understand. And it closes firm. So you've got a lot of congestion in here, and your trade is going nowhere. And so this is telling you that it's going to try to push back up again. And so if you're short from here, by this point, and this is now 5, 10, 15, 20 minutes later, so you got plenty of time to figure this out, you say, the heck with this trade, I'm getting out of here, and you scratch it. And at this point, you scratch it, and basically you're out at break even. No loss there. And that's what you do. You have to manage what you put on. Here, now this is a better trade overall because there's a failure to follow through to the upside. It's proven that it can't go up. So you want to see this now go down, and then you get this kind of price action showing you that that, you know, there's movement coming down. And it starts to get choppy down in here, but you had good movement up to that point. But you don't have, you know, even in through here, you don't have any of that. This bar might have caused you some concern, right? But it's not the same as this, where you've got 2 or 3 bars in a row closing off on their highs in here, dipping down and closing on their highs. This is demand in here. Good question. Do you still like the upthrust at D after the selling climax stopping volume prior to that at 9:30? Yeah, because this is all supply coming down here. When I look at this, what I'm also thinking about is that I got big down waves in here, and my up waves are pretty minor, right, compared to the big down waves. So I'm not too concerned about that. This also, selling climax here often will get tested. The traditional Wyckoff way of looking at a selling climax is to see climactic action, which is here, and then the automatic rally in here, and then secondary, what they call secondary testing, coming back down into the climax area, into the high volume area, to see if there is still volume to the downside. Because sometimes climaxes don't, like for example here, this climax didn't get an automatic rally and didn't end at that point. So they will virtually all the time come back down to test. Sometimes they go right down to the low, sometimes they go a little bit below, sometimes they stay like this, a little bit higher, but this would be a secondary test. So given that, you would expect that to happen. That's the normal state of affairs here. So an upthrust is just telling you that we're either going to see the secondary test of that climactic action, or we're going to see a whole new leg down. Now you're playing for the leg down, but you only got what you got. You know, you can't get more than what they give you. Let's see, on the bar that tells you that the market will turn back up, how does volume confirm that? Volume is less important in here because you're in chop, right? You're in choppiness. I think you got a little pickup in volume, but it's minuscule, so that's not really what's helping you there. It's the price action itself. Precisely, but the upthrust is the better entry, since the first lower high or higher low setup often is a complex entry requiring an ABC or an ABCDE. Yes, exactly right. So this kind of fits into that too, doesn't it? It's just too bad that the day ended here, or that this movement didn't happen earlier, because I think you would get another leg down. This was pretty dramatic move in here. Why would you take a short at the selling climax and only go for a test of the climax? Well, we really weren't. We're looking, as I say, we're looking for a new leg down. It just happened to be that this did turn into a selling climax, mainly because of the hour of the day.